viewers, I'm here to share with you about my stock account. Today we can see that my stock account has closed at 1.59% to $68,804.19 US. Today, both SQQQ and United Natural Gas closed out with a gain, and SQQQ rose for 1.99% to 19.51, and United Natural Gas closed up 0.13% to 7.49. Both of the ETFs and the stocks closed higher as the market closed generally lower. Dow Jones Industrial Average closed up 0.30% to 35,281.4. Nasdaq Composite closed down with a loss of 0.68%, and S&P 500 also closed down to 4,464.05, a loss of 0.11%. Today we can see that the semiconductors closed especially down. And today we're going to be talking about the interest rate of TIPS, the Treasury inflation protected bonds. At the present, the yield is once again approaching 5% of U.S. short-term treasuries, attracting the attention of the whole market. However, another key interest rate in the United States is on the eve of historic breakthrough. The yield on the 30-year inflation-protected treasury bonds in the U.S. is approaching the 2% mark indefinitely. If it breaks, it will be the first time since 2011, and countless bond investors are waiting for bated breath. For some investors, the Fed has raised interest rate by more than 5% percentage points over the past 18 months, meaning a real yield of 2% is an attractive place to buy. However, there is also a view that there is uncertainty about whether U.S. inflation has peaked, coupled with increasing demand for borrowing by the U.S. government. Various long-term yields may rise further. Interest on the inflation-protected treasury bonds is paid on the basis of an inflation-adjusted base amount. Therefore, its yield represents a risk-free rate of return and is also regarded as one of the barometers of the economic outlook. The last time the 30-year TIPS yield exceeded 2% was 2011. Since then, the 30-year TIPS yield has fallen to around 0.50% in 2020 and to 2021 as the Fed sharply cuts interest rates and demand for inflation preservation soars. Rob Wadner, chief fixed income strategist at Invesco, said, "Our view is that both nominal and real government bonds should be held. Nominal growth rate is slowing and is below the nominal interest rate. There is also risk that the rapid tightening of current policy and the Fed may be making mistakes. For long-term indebted investors such as pension funds and insurance companies, a 30-year TIPS yield close to 2% could be irresistibly attractive." Michael Pond, head of global inflation-linked research at Barclays, said, "These investors have little interest in the 30-year TIPS over the past decade, but at the 2% level, this group of investors may return to the market." Therefore, the issuance of the U.S. 30-year TIPS scheduled for August 24th will be a litmus test. As the last auction of inflation-protected government bonds held on July 20th, the market demand was quite hot, and the yielding bid yield was 1.495%, the highest since 2010. Some of the upward pressure on TIPS and long-term nominal treasury yields reflect high uncertainty about path of inflation. Despite a decline in inflation measures released this week and inflation expectation from surveys, crude oil prices have risen to their highest level of the year, and house insurance may also start to push up inflation. Michael Kuntzel, portfolio manager at Pacific Investment Management, PIMCO, said, "We need to higher real and nominal yields. Our baseline forecast is a significantly breakdown, a slowdown in the economy, which will further lead to a recession and eventually lower interest rate. But we have the potential to see more inflation premiums on the curve that we haven't seen in a long time. At the same time, market sentiment is taking a hit," Citibank strategist Edward Action wrote in a note on Friday. "The longer the 30-year TIPS yields stay above the 1.86%, the more likely it is to move towards a new cyclical high, with a medium-term target likely to be 2.28% of the 2010 yield high. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.